Welcome back to EDS, and in this video I'm going to show you how you can grow a small account step by step. So the first thing you want to do is open up your brokerage platform and you want to navigate over to any equities underlying. We're just going to have UAL up. It really doesn't matter what you pick, and we're going to be writing options contracts or selling options contracts, and the main things we want to be focusing on is high implied volatility, high probabilities of success, and we want to be managing our position sizes. So once we've got our underlying up and ready to go, what we want to do is navigate over to where we can see a list of expiration dates for that underlying, and we want to pick an expiration date that we're going to use to mock up positions moving forwards. So the one that we want to pick needs to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only expiration date that actually fits that criteria is February 21st, which is 58 days away. Today is Christmas Day, so Merry Christmas to everyone. The market is open, but there's no liquidity, there's no volume. So the spreads are going to be slightly wide for the purpose of this example. So 58 days away. So we can take that information, come over to our watch list, and we can simply filter out any and all underlyings that have an earnings event over the next 58 days. And the reason for this is because we simply want to avoid having increased volatility around the earnings announcement. And we also want to avoid potentially having the earnings announcement mess up our deltas. Both of these things will negatively impact our P&L, and we also want to filter out anything with a low liquidity rating level. At this point, I like to personally order everything from high to low IV rank. This is a matter of personal preference, and this is a pre-made watch list. You can use any watch list that you like. It doesn't matter what you choose. And at this point, we simply want to see what would fit well inside of our portfolio. And we want to be looking at things with an IV rank of over 30, ideally over 50. So we're just going to go down the list and we're just going to have a look at everything one by one. Now, the first thing that actually comes to mind is EWZ, which is the Brazil ETF. It has an IV rank of 67.5. It's currently trading at just under $23 a share, which means that even if you have a small account, you will most likely be able to put on a position. And it has an absolute IV level of 31.3%. So let's just go over to the list of expiration dates for EWZ. And we already know we're going to be 58 days out in time at the February 21 expiration date. Now, as we mentioned, the spreads are a little bit wide today. That's because it's just Christmas Day, but we're just going to be using this as an example. We're not actually going to send this order to try and see if we can get it filled. So what we want to do is, as we mentioned, we've already locked in on the high implied volatility because we know that the implied volatility is high relative to the previous levels of implied volatility for this underlying because we looked at IV rank. And we want to now, and the second thing is it's a small underlying, so it's going to be suitable for small accounts. And the third thing is we want to ensure high probabilities of success. Well, when we are writing options contracts, we basically don't want price to cross over the strike that we write the contract at. We want price to stay away from our contracts, which is the opposite of if we were to buy contracts. So what we want to do is we want to use this vertical orange bar here, which is the expected move of EWZ over the next 58 days. And we want to use this to try and find the best strikes to sell our contracts at. And we can also use the dotted blue lines, which is the standard deviation levels. And we can also use delta, because in order to get a high probability of success, we want to, of course, sell contracts that are outside of this expected move. But how far outside do you go? Because the further out you go, the less premium you'll collect. So there is a sweet spot. And for me, that sweet spot is anywhere between 15 and 20 deltas. There's an 18 delta here at the 26 strike. However, we are going to be slightly more aggressive because obviously there's just no volume. and the spreads are super wide. So just so we can get a fairly accurate representation, we're just going to go with the 25 strike, which is still just inside the one standard deviation level. And we're going to do the exact same thing over on the put side. We're just going to go with let's go with a 15 delta on the put side, which is slightly more conservative. And as you can see here, we've basically created a range for ourselves between $20 and $25, the strikes I'm referring to. So as long as price stays within this range at expiration in 58 days time, we will keep 100% of the premium that we collect up front. And if we look in the bottom left corner, we have a 76% probability of profit or pop. What that means is there's a 76% chance of us being able to make at least 1 penny on this trade at expiration. And if we wanted to get out of this position at 50% of max profit, we've got an 85% chance of being able to do so. This is, of course, if we don't want to hold all the way to expiration. Now, so what we're looking at is between a 76 and 85% chance of success, which is a very, very high probability of success. Now, we would collect 98 cents up front, as we can see here in the bottom middle. There's a contract multiplier of 100 for equities, so we'd multiply that out by 100 and we get our max profit of $98. And our broker is going to require $200 or just over $200 in buying power to open this position. Now, this is a very, very high return on capital trade. I'm assuming it will be slightly lower in reality once some volume comes back into the market in the new year. However, you get the idea. You can get a nice return on capital with a very high probability of success, and this only requires $200. So even this is suitable for even the smallest of accounts. Now, how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template. The link is in the description. And the way it works is you enter in the size of your portfolio at the top, and then you enter in what the current VIX level is below it, and everything will then be automatically calculated for you. And at this point, you simply just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power you should be allocating to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this, you will be absolutely fine over the long term. If you would like to learn in more detail about what we do and how we do it, again, link is in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There is also a full course, so no prior knowledge is required. We will teach you absolutely everything that you need to know from start to finish. And if you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee. So after 6 months, once you've gone through the course and followed some of our trades, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free for you. And right now, it's £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.